You work hard. You earn regularly. You check your bank account and still wonder why the number never seems to move in a meaningful way. Months turn into years. Salaries increase slightly, but the balance stays stubbornly flat. This isn't bad luck, and it's not because you're incapable of saving. The shocking truth is that modern money systems are designed in a way that quietly drains your income before it ever has a chance to grow. What you don't see is what hurts you the most. Today, we will talk about this is why your bank balance never grows. Shocking truth. So, before we start, make sure to hit the like button and subscribe to my channel. You're confusing income with wealth. One of the biggest reasons your bank balance never grows is because income is not wealth. Income is what comes in. Wealth is what stays and multiplies. Many people earn more over time but upgrade their lifestyle at the same speed. Bigger phones, better cars, more subscriptions, frequent food delivery, and brand-driven spending absorb every raise. When expenses rise alongside income, your financial position remains exactly where it started, just with nicer stuff and the same stress. Lifestyle inflation is stealing your future. Lifestyle inflation is silent and socially encouraged. The moment you earn more, expectations rise, both yours and society's. You feel deserving of comfort upgrades, and marketers are happy to reinforce that belief. The problem is that once lifestyle inflation locks in, it becomes permanent. Cutting back later feels like punishment, even if it's necessary for survival. This is how people earning good money still live paycheck to paycheck. Your bank is not helping you grow money. Keeping money in a regular savings account feels responsible, but it's often a losing strategy. Inflation quietly eats away purchasing power every single year. If inflation is higher than the interest you earn, your money is shrinking in real terms even though the number looks bigger. Banks profit from your deposits by lending them out at much higher rates, while you receive crumbs in return. Your balance feels safe, but it's slowly bleeding value. Debt is quietly eating your cash flow. Debt doesn't just cost interest, it steals your future income before you earn it. Credit cards, personal loans, buy now, pay later plans, and long-term financing reduce your monthly flexibility. Even small EMs stack up. When a large portion of your income is pre-committed to past decisions, saving becomes mathematically impossible. Many people believe they'll save once the debt is gone, but often replace old debt with new debt, repeating the cycle. You were never taught how money actually works. Most people were taught how to earn, not how to manage. Schools rarely explain compounding, inflation, asset allocation, or tax efficiency. As a result, people rely on advice from friends, social media, or sales-driven institutions. Without financial literacy, you're playing a game without knowing the rules, and the house always wins. Taxes and hidden charges are draining you. Taxes are one of the biggest expenses of your lifetime, yet most people treat them as unavoidable instead of manageable. Poor planning leads to missed deductions, inefficient structures, and unnecessary penalties. Beyond taxes, there are hidden fees everywhere. Bank charges, fund expense ratios, insurance riders, late fees, currency conversion costs. Each one seems small, but together they quietly drain thousands over time. Social Security is not a complete safety net. Many people believe Social Security alone will take care of them in retirement. In reality, it was designed as a foundation, not a full solution. Depending entirely on it can leave you vulnerable to rising healthcare costs, inflation, and lifestyle gaps in old age. Understanding how benefits work, when to claim them, and how they fit into your broader plan is critical. Programs connected to institutions like the Social Security Administration are important. But they are only one piece of the puzzle, not the whole picture. You're saving what's left instead of paying yourself first. Most people save only if money is left at the end of the month, which usually means nothing gets saved. Wealth builders reverse this logic. They save and invest first, then live on what remains. Automating savings removes emotion from the process and forces discipline. Without this system, saving becomes optional, and optional habits rarely survive long-term. Fear keeps you from investing. Fear is one of the most expensive emotions in personal finance. many people let their money sit idle in savings accounts because they're afraid of losing it, not realizing that doing nothing is a guaranteed way to lose purchasing power over time. Inflation silently erodes the value of cash every single year. Your money may look safe, but in reality, it's shrinking while you watch. This fear is often fueled by headlines about market crashes and stories of people who lost everything. What's rarely discussed is that these losses usually come from speculation, poor timing, or lack of diversification, not from disciplined, long-term investing. Smart investing is not gambling. It is structured, diversified across assets, and aligned with a long time horizon. It's about owning productive assets and letting them grow, not chasing quick profits. You chase quick fixes. Instead of long-term systems, get-rich-quick schemes are seductive because they promise speed without sacrifice. Viral side hustles, overnight success stories, and flashy income screenshots create the illusion that wealth is something you stumble into rather than something you design. Social media amplifies rare outliers and hides the thousands who failed following the same path. This constant exposure rewires expectations, making slow, steady progress feel like failure, even though it's the only approach that actually works. Real wealth is built through systems, not bursts of motivation. Systems are boring by design. Automated investing every month, living below your means even when income rises, planning taxes before you owe them, and thinking in decades instead of weeks. These actions don't trigger dopamine hits or attract online applause, but they compound quietly in the background. While others chase the next hack, system builders let time and consistency do the heavy lifting. Quick wins also create fragile finances. Income that arrives suddenly often disappears just as fast because there's no structure to support it. Without budgeting discipline, emergency funds, and long-term investment plans, any financial gain, no matter how large, leaks away. This is why many people who experience sudden success end up back where they started, wondering how it all vanished. Your environment is working against you. Consumer culture is engineered to keep you spending. Apps, ads, influencers, and limited-time offers constantly trigger emotional purchases. When everyone around you is consuming, saving feels abnormal. Without consciously designing your environment, unsubscribing, limiting exposure, and setting boundaries, you're fighting a system designed to drain your wallet. The shocking truth: your bank balance isn't stagnant because you're lazy or unlucky. It's stagnant because no one warned you that the system rewards spenders and punishes passive savers. Without intentional strategy, money flows out as easily as it flows in. Growth requires awareness, structure, and patience, none of which are naturally encouraged. Once you understand why your bank balance never grows, you gain back control. The moment you stop blaming income and start managing behavior, systems, and strategy, everything changes. Wealth isn't about how much you make. It's about how much you keep, protect, and grow over time. If you liked this video and would like to see more like it, please give it the thumbs up. Leave a comment and click the button to subscribe.